All right. So what's the real lesson here to our listeners?
Well, one is that you can make projections, but they're just projections. And the reality is what actually happens, and that's what matters in the end. Secondly, good stocks don't always beat good markets. Nobody would argue that Apple and Amazon are not great companies.
Mm-hmm.
They're fantastic companies. They're huge companies, but they didn't beat the market. And number three, which is one that we always support here, is that benchmarks matter more than opinions. Because in the end, the benchmark is what the market delivers.
That's a really critical one because I've been sort of warning a lot of investors that we've been spoiled with returns these last 2+ years.
Right.
And you could argue that we're 4 years into a bull market in the US.
Mm-hmm.
And those bull markets tend to last about 5 years in duration. So it's not that we haven't appreciated the returns that we've received, but just sort of setting the stage for, well, what happens when the market goes down? That's where that relative return becomes really important. It's one thing to say, okay, well, SanDisk did 559% last year.
Yep.
Awesome. But, let's say we're going into a bear market and the market sells off, 20, 30%, which probably will happen at some point.
Sure.
Well, it will happen at some point. Then you're going to want to compare your returns to actually what the market did.
That's right.
So even if you got let's say a negative 10% return in your portfolio when the market was down 20%, you actually probably did pretty good.
That's a win.